Welcome to China Perspectives, a podcast on the latest economic and credit market developments in China, featuring experts from both within and outside of Fitch Ratings. As the first international credit rating agency to set up an office in China, Fitch offers the unparalleled experience and insights into the market.
Welcome to China Perspectives, our first episode of 2026. My name is Ying Wang, Head of North Asia Industrials, Property, Consumer, and Utilities at Fitch Ratings. As we do at the start of each year, we're joined by Fitch analysts to discuss the credit outlook for their respective sectors. Joining me today are Jeremy Zook, co-host of China Perspectives and Fitch's China Sovereign Rating Analyst, Grace Wu, Head of the Greater China Banks team, and Sam Kwok, Head of APAC International Public Finance. Together, we will explore China's economic outlook for 2026 and what it means for the banking and public finance sectors. Jeremy, let's start with the macro view. We know that China has been battling deflation for more than 2 years, and so far, the policymakers' fiscal and monetary policies to boost domestic demand and reverse deflationary pressures have produced quite limited effect. Do you think 2026 is going to be any different? And what's your expectation on growth and policy directions in 2026?
Thanks, Ying. Our expectation for GDP growth in 2026 is 4.1%, and this is a bit of a moderation from the 5% growth rate that we saw last year. Now, what's driving this is that we continue to see a bit of a two-speed economy in China. Very strong external demand against rather subdued domestic demand. And these domestic demand challenges are relatively broad-based, focused on, relatively weak consumption, ongoing property sector declines, and broader investment dynamic. In terms of external demand in 2025, despite it being a very volatile year with U.S. tariffs, actually held up quite well and helped to drive growth that was slightly above our expectations last year. We do expect this resilience to continue in 2026, but at a moderating pace. And so it doesn't provide quite as much offset to the domestic demand dynamics that we expect. On the domestic side, we see consumption continuing to struggle. If we look at retail sales in 2025 performed okay. That was on the back of consumer goods trade-in program that the government rolled out. But towards the end of the year and in the second half of the year, the effect of the trade-in program ebbed and retail sales began to slow. Services consumption could offset part of this, but again, it's starting from a relatively low base. And, I think more broadly, we see a lack of confidence in the economy being quite a constraint on consumption. Consumer confidence is at low levels because of ongoing wealth effects from the property sector correction, as well as more challenging labor market outlook. Now, I think importantly, we are seeing also a fall in investment. So if we look at fixed asset investment, it was down 15% year over year in December. And investment contributes about 40% of China's overall GDP, so quite a significant amount. Now, the translation of fixed asset investment to GDP is not one-to-one, so the fixed asset investment decline does overstate the impact on GDP. But nevertheless, we think this will be a drag on the economy. This, of course, reflects the ongoing drop in the property sector that's been persistent for several years now, a broader investment decline from infrastructure because local governments have been a bit constrained on the fiscal side. And then I think more importantly, a bit of a decline in manufacturing investment, which we think reflects overcapacity as well as the government's anti-involution campaign. Additionally, China's continuing to deal with deflation. Measured by the GDP deflator, China's been in deflation now for 11 straight quarters. We do expect this to turn towards zero and then slightly positive in 2027, but remain at relatively low levels. CPI inflation, of course, has increased, but PPI inflation is still negative, though declining at a slower pace. So what does this mean in terms of the policy response? Well, the government has continued to emphasize expanding domestic demand. We saw this in the Central Economic Work Conference readout from December, continued focus on using fiscal support in particular to boost domestic demand. The question is, what will the degree of this be? We don't expect a large fiscal stimulus next year, and we expect support for domestic demand to be incremental and gradual. In terms of our fiscal deficit forecast, we think the fiscal deficit will be slightly smaller than it was in 2025, or at most around the same level. So, an overall neutral fiscal policy stance. You could see more of a shift in the composition of this fiscal support towards consumption, more consumer goods trade in program measures, which have already been extended, and targeted subsidies towards households, and more central government involvement in terms of transfers to local governments. So these policies could have some marginal benefits to growth. On the monetary side, we see some slight monetary easing, about rate cuts of about 20 basis points, but we see monetary policy as somewhat constrained in the current environment. And on the property sector, we've seen again continued modest measures to support the property sector, but we don't really expect much in the way of big measures that could really turn around the property sector in this next year.
Thank you, Jeremy. That was a very comprehensive summary of the macroeconomic outlook for 2026. You ended with the property sector, so let me stay on that and talk about our outlook for this year. We are maintaining a deteriorating outlook for Chinese home builders, which are entering their fifth year of this down cycle. We expect the sector to continue contracting, with new home sales likely to fall by around 7 to 8% on a year-on-year basis. While the declining sales seems to be gradually moderating, the sector continues to face significant structural challenges. In 2025, the new home sales volume was still about 20 to 30% above our estimated long-term equilibrium level, which points to ongoing downside risk. And like you said, against a soft macroeconomic backdrop, there is limited scope for a meaningful turnaround in the housing market. Now shifting to the local government sector, Fitch has a neutral outlook in 2026. Sam, with the ongoing economic challenges Jeremy touched upon, what kind of risks could cause the outlook for Chinese local governments to diverge from this baseline?
Yes, thank you, Ying. I think just to give our audience some context, a large part of the focus on local regional governments, or LRGs, has been on the rising debt level, which has more than doubled in the past 5 years, while revenue growth hasn't caught up with the pace of the debt. Now, looking into 2026, our neutral outlook has mostly factored in prolonged recovery. Now, we're seeing some light at the end of the tunnel. We'll share some thoughts on the two issues, which I want to tackle. I think the first is from a revenue perspective. We're not expecting revenue growth to rebound in 2026, perhaps slightly modest growth. Having said that, if we were to look back at the third quarter of 2025 and since then, we saw some momentum of resumption of growth, but the growth has remained below nominal GDP growth. So the investments that the LRGs have made hasn't translated to revenue growth yet. Now, there tends to be a lag as these projects can be longer term in nature. Now, the second part is on the debt. And a big part of that growth has been the $10 trillion debt substitution plan. So these are money that are issued by LRGs to repay LGFV debt. Now, when we perform our analysis for LRGs, we've already included a part of that LGFV debt in our calculations. So from a system perspective, this was not new debt. Now, we expect sort of the debt substitution to account for around half of the new debt growth in 2024, 2025. And this debt substitution is expected to peak in 2026 and moderate thereafter. So actually, when we exclude the impact on the debt substitution, the normalized growth rate at the local regional government level is around the range of 7 to 8% in 2025. Now, obviously, in 2026, if the LRGs or their LJVs resume a vast debt growth, say there's a big stimulus plan to boost investments, this will be credit negative, but this is not our base case. Now, over the longer term, there is still challenge. So we know we talked about the LRGs having spent a large amount of money. So the question is whether that debt will translate into future revenue returns. So back to you, Ying.
Now, Grace, over to you. With a deteriorating sector outlook for Chinese banks in 2026, What specific strategies are banks using to stabilize their financial performance?
Well, our deteriorating sector outlook for Chinese banks underscores the ongoing pressure on profitability this year. Banks are still seeing pressure on their margins due to the low interest rate environment. And on top of that, bank asset quality remains a concern given slower pace of economic growth, stress in the property sector, domestic consumption weakness, and local government debt burdens, all of which we've just discussed. And because of these pressures, banks are becoming more cautious with their lending. For 2026, we expect loan growth to remain subdued at around 6.5%, which is below historical trends. Banks are tightening their risk controls, especially for higher risk segments such as SMEs and unsecured retail borrowers, since these borrowers are more vulnerable in a downturn. The saving grace is that we expect the pace of net interest margin contraction to moderate, and thanks to smaller cuts ahead, this should offer some relief to the sector's earnings. And at the same time, banks are focused on maintaining their capital buffers so that they are better positioned to absorb potential deterioration. So overall, these strategies are helping banks to manage higher credit costs and maintain financial stability, even as they navigate more challenging operating conditions.
Coming back to you, Jeremy, the Chinese government's anti-involution campaign, which targets excess manufacturing sector capacity, seems to have contributed to a steepening decline in investment, along with slowing capital spending by local governments. Does Fitch expect the government to dial back some of these anti-involution campaign measures to boost investment to some extent in 2026?
Yeah, so I think if you look at fixed asset investment over the past few years, certainly the property sector decline has been the key contributing factor. And for quite some time, that was offset by both infrastructure and manufacturing investment. But what we've seen more recently, and especially since the middle of 2025, when the government really turned up its anti-involution campaign, is that manufacturing investment has started to slide a bit. Now, what is involution? I mean, involution, as you say, is about targeting kind of this excessive competition among firms. Firms essentially attempt to gain market share by building out their capacity and lowering prices to such a high degree that you just get this downward spiral of falling prices and excess capacity, where corporate profitability generally is quite eroded. Now, the anti-involution campaign, of course, was then rolled out to sort of target this excessive competition and excess capacity. And some of the measures seem to be around trying to include against price reductions, reducing government subsidies to industries, and then a bit of moral suasion as well to firms to try to get them to reduce their investments. Now, given the decline in investment overall, we do think that the government will be likely to calibrate this strategy and loosen it a bit as they, are likely to be a bit concerned about these investment trends. I think additionally to that is that, the government still emphasizes its investments in advanced manufacturing in its upcoming 5-year plan. And so maintaining that will require firms to continue to invest.
Sam, do you expect local government's investment spending growth to pick up with tax revenue returning to growth and capital revenue stabilizing?
Thank you, Ying. We get asked a lot, why isn't the LRGs doing more? I think Jeremy talked about the drop in the FAI in 2025. But what we'll say is LRGs are already doing a lot. Now, if we are looking at, let's say we're looking at the capital expenditures for the first 11 months of 2025, the capital expenditures was up 6.6% year on year. Now, if we remove the capital expenditures related to making land ready for sale, the capex was much faster. Having said that, LRG investments alone is not enough to be driving some of this FAI growth. Now, one interesting trend that we want to share is that the LRGs are shifting away from the traditional infrastructure spending towards industrial development. And in 2025, we've seen that some LRGs are issuing special purpose bonds with the proceeds used to invest in state-led industrial funds. Now, there is limited transparency on the track record of the future returns for these projects, so there is a bit of uncertainty here. Now, I also want to talk about sort of the revenue. Obviously, if revenue rebounds, there's more money to spend, but revenue hasn't yet shown a sustained recovery. But as we mentioned earlier, the recurring revenue, such as taxes, has shown signs of resuming growth. And I think the structure of the revenue has improved a little bit. Now, if we recall from 2024, a big part of that revenue growth was coming from fees and fines, which is less recurring and less sustainable. Now, if we were to look at the land concession revenue, it's likely going to stay weak, and a rebound in 2026 is very less likely. Having said that, the land concession revenue is no longer a major driver. I think if we were to include transfers from central government, land concession revenue is only around 20% of the total. So essentially, going into 2026, we believe LRG's ability to raise capital spending should remain limited. If LRGs need to further increase their investments, this will likely require the help from the central government.
Grace, what does this mean to Chinese bank asset quality? How are banks shifting their lending priorities in response to the current environment?
Well, we still expect the banks to be very cautious in terms of lending this year. Although the government has introduced supportive measures to support domestic consumption, for example, allowing subsidies for some personal consumption loans and reducing down payment requirements on commercial real estate purchases. But growth in unsecured retail lending, and these are mainly credit cards and consumer loans, has slowed sharply in recent years. The lowering of minimum down payments, announced in January 2026 for commercial real estate purchases from 50% previously to 30% now, this reflects a continuation in terms of preference for incremental targeted easing, in our view, rather than broad-based credit stimulus. So on that front, we still expect the Fitch adjusted total social financing ratio to remain under 280% of GDP in 2026, and that it was sustained at similar levels over the medium term. A lot of these measures are intended to relieve funding pressures for small enterprises, the private sector, selected real estate developers, but with an overwhelming emphasis on preserving financial system discipline. So, to us, the effectiveness of some of these policies in terms of reviving aggregate credit demand is still quite uncertain. We still expect banks will continue to prioritize their underwriting discipline and stability over aggressive loan expansion. Also, there is a risk that if these measures may only postpone rather than resolve underlying credit issues if the borrowers' financial profiles do not improve.
Last but not least, Jeremy, Fitch downgraded China's sovereign rating in April 2025 from A plus to A flat. China's government debt to GDP ratio will further increase in 2026 as a result of elevated fiscal deficits, local government debt swaps, and deflation. What kind of rating headroom currently exists in the A flat stable sovereign rating?
So, as you mentioned, we downgraded China's sovereign rating to A with a stable outlook back in April of last year. And the key rationale for that was the relatively loose fiscal policy settings that were being put in place to combat some of the economic challenges that I discussed earlier around weak domestic demand and ongoing deflation. And of course, this is contributing to a resulting rise in government debt at a relatively high pace. Now we see that rise in debt continuing. So our estimate is that debt rose to 68.5% of GDP in 2025 from just under 61% in 2024, and will continue to rise further to about 80% of GDP in 2027. There are really two key factors that are driving that. So again, the high fiscal deficits and our expectation that fiscal consolidation will only happen very gradually, and then the low deflator growth. Even if the deflator does turn slightly positive in the coming years, we expect it to remain relatively low, and this will contribute to some worsening in debt dynamics. Now, these forecasts are still largely in line, maybe slightly worse than what we expected at the time of the sovereign review. But I think from a ratings perspective, there is headroom now that we are at a slightly lower rating level to accommodate a bit more of a deterioration in some of the fiscal metrics that we've been seeing. But it will depend on kind of how persistent these economic and fiscal pressures are over time.
Jeremy, Grace, Sam, thank you so much for joining the podcast today. I look forward to more insight sharing from you in 2026.
You've been listening to Fitch Ratings China Perspectives podcast. To learn more about our ratings and research on China, visit us at fitchratings.com. Subscribe to China Perspectives wherever you get your podcasts.